Hi, everyone, and welcome to our webinar. We're going to talk about a very interesting and timely topic. We have two papers digging into economic properties of decentralized exchanges, which is an important area, a growing area of DeFi, and there is a lot to be learned about it. The two papers that we have here today are quite a treat. I enjoyed reading them myself a lot. They apply traditional finance economic tools to understand these problems. They make very good progress. It's in some sense sort of old school first principles theory, and it's kind of a pleasure to read these papers. So I hope you enjoy them as well. I'm going to introduce our first speaker. So Anthony Zhang is going to be the first presenter. He is an assistant professor of finance at the University of Chicago Booth School, and his research covers a range of topics, and not just crypto and DeFi, but also financial intermediation, banking, household finance, and so forth. And his paper is about understanding the cost of liquidity provision through automated exchanges, and how to describe it analytically, and how to think about efficiency of these exchanges. And without further ado, I will give the floor to him. The paper is Automated Market Making and Loss versus Rebalancing. Anthony, the floor is yours.
Great, so I'll get started. Thanks a lot, very happy to be presenting here. So I'll be presenting paper co-authored with Jason Milionis, Ciamac, Moallemi, and Tim Roughgarden, who are all here. All right, so let me just jump in. Topic of this paper is automated market makers. So probably somewhat familiar to most of this audience, a brief overview of what these are, right? So suppose you want to set up a system that allows us to trade two assets, say Ethereum for US dollars or vice versa, right? Traditional solution is to set up a limit order book, right? Everyone can put offers in to buy or sell prescribed quantities at certain prices, right? And you match pairs of mutually acceptable offers, and sort of you basically run a continuous auction, right? And so the problem with this is that it's pretty costly to sort of compute and store on chain all of these limit orders, right? You need people to actively participate in a world where sort of computations are very expensive and keeping track of data is very expensive. This is not a very efficient way on a blockchain to do market making. And then so an interesting solution that has arisen and gained a lot of product market fit in blockchain world is automated market makers, right? And the basic idea of an automated market maker is that a liquidity provider supplies like a pool of US dollars and Ethereum, right? And then the market is always willing to basically buy or sell any amount of an asset at a given price, right? And then so the price is just a function of how much of assets, how much Ethereum and how much US dollars the pool has, right? Liquidity providers have an incentive to provide liquidity into these automated market making pools because they get some fees, right? And kind of the reason this kind of took off in blockchain is because it has relatively low storage needs. Computations can be done pretty quickly. So the question we want to look at in this paper is, when does it make sense to put money in one of these pools and in an automated way make markets for US dollars against Ethereum, right? And sort of to clarify, what exactly is the cost of being a liquidity provider in an automated market maker pool? Many of you are probably familiar with the idea that there's some kind of like adverse selection, there's some kind of impermanent loss. What exactly is this cost? Can we write down formulas to quantify what is the cost of providing liquidity to an automated market maker? When is this cost high versus low, and so on? So that's kind of what we want to do. What we think we are doing here to kind of like maybe put a sort of slightly grand picture of what we're trying to do. What we want to do is to build something like a Black-Scholes formula for liquidity provision on automated market makers. So the Black-Scholes formula for option pricing is a formula that you might look at as doing two things, right? Qualitatively, it's a formula that gives you comparative statics. When are options valuable, right? You can decompose option returns into delta, sort of exposure to volatility, so on and so forth, right? So on the one hand, we want to qualitatively write down a model that says, when are your returns providing liquidity to an AMM going to be high versus low? We're going to link this to basically three things. Volatility, how much do prices move around? Curvature, how curved is the slope of your AMM curve? And how much fees are you collecting? But beyond being a qualitative model that says sort of gives you comparative statics, Black-Scholes is also powerful because it's a quantitative model. You can actually bring it to data. You can actually predict what the prices of options should be using Black-Scholes, right? So we're going to go a step further than just these comparative statics and also write a model which we think is quantitatively realistic enough that you can actually bring it to data and quantify how much, what's the number of how much you're losing as an LP. So kind of we're trying to do this dual thing where we're trying to qualitatively and quantitatively have a formula that lets us understand AMM liquidity provision. Qualitatively, the core insight, which also happens to be very reminiscent of Black-Scholes, Black-Scholes basically says we can understand options by taking options and basically replicating them using the underlying stock. We're going to do something which is very similar. We're going to take an AMM and say an AMM is a machine that holds at any given point in time a bunch of Ethereum, a bunch of US dollars, right? And it has exposure to Ethereum. Well, let's try something which is let's consider a strategy which basically delta hedges the liquidity, the LP position. So however much Ethereum your pool is holding at any given point in time, let's short that much Ethereum. And this is interesting because once you do that, you eliminate the market risk component of the LP's returns. If you hold an LP position, you're long Ethereum, and the value of your LP position is affected by the fact that whenever Ethereum prices move, your pool position is going to, your pool value is going to change. Once you short that out, we isolate kind of, we eliminate the market risk, and then we can ask what is left. It turns out that a liquidity provision, an LP position, once you short out the market risk, is a sum of two things. How much fees you are collecting as people are trading with your pool, and an object that is sort of the core of this paper, which we call loss versus rebalancing. So what is this thing? What is LVR? What is the core cost of providing liquidity as an LP? Loss versus rebalancing arises from price slippage. The design of an AMM is such that it only ever learns prices of Ethereum when it gets sniped. When Binance prices update, the AMM does not proactively update prices. It sits there, it waits until people bought a bunch of Ethereum from it, and then it updates prices. As a result, every trade that the AMM makes, it makes at worse than market prices. There's kind of slippage in a sense reminiscent of, for example, HFT slippage, British Crampton Shim, and sort of papers like this. And what is a loss for the AMM, because it's trading at off-market prices, is profit to arbitrageurs who basically snipe the AMM and tell it that, oh, Binance prices change. And then we give you a very simple formula, which is quantitatively a quantitative formula for how much does an AMM lose from slippage. And effectively, what we're going to show is the cumulative amount lost to slippage trading at off-market prices depends just on two things. It depends on how much do prices move around. Prices move around more, you get sniped more. And then X prime P is how much Ethereum are you trading when prices move by a bit. And we call this marginal liquidity. We're going to talk about how this is connected to the slope of the AMM curve. So AMMs lose money from slippage, and AMMs lose money from slippage depending on how much prices move around and how aggressively the AMM trades when prices move around. Qualitatively, this is kind of interesting because of two reasons. Firstly, it kind of illustrates where is the loss coming from AMMs, right? It's coming from this slippage, and it points to the fact that we could redesign AMMs to limit slippage and then sort of decrease LVR. The other thing is that we have this thought experiment of delta hedging an AMM, right? And then we'll talk about how you can actually run this trading strategy. You can actually attain fees minus LVR in practice very simply by investing in an LP position and delta hedging it by just doing a bunch of trades on Binance. That's kind of qualitatively what we want to do. Quantitatively, besides doing comparative statics, our model is, we hope, realistic enough that you can actually bring it to data. So then here is a picture of basically the LP pool for Uniswap V2 Ethereum USDC pair. So trading Ethereum against the USDC stablecoin, right? And you see basically that in this pool, we have around $125 million of liquidity compared with 21 million of volume. So fees are around 60K, right? If you just totally ignore the fact that AMMs have costs, you could do a super naive calculation and say basically, well, I'm making 66K in fees a day on 125 million of capital. So all of the money in the pool on average is making around 20% returns annually, right? And the thing is, this ignores the cost, right? So how do we quantify the cost? In our formula, it turns out for the constant product market maker, we have an extremely simple formula for costs. The formula is that the annual loss, or the loss of an AMM, is simply sigma squared over 8 in percentage terms, right? So what does this mean? How much money do arbitrageurs make by sniping this pool when prices move around? How much does the AMM lose because every trade it's making, it's doing at prices slightly worse than what prices are on Binance? For the constant product market maker, we simply take volatility squared and divide by 8, and we get that number. What we have is 3.1 basis points a day. This works out to approximately 10% or so a year, right? So a benefit of our theory is we're able to put a number on this and say basically like the arbitrageurs on a $125 million pool are able to make 3 basis points a day when volatility is around 5% a day of Ethereum prices in sniping this pool. And then so we can then plug this cost in and say sort of you're gaining 66K from fees, you're losing 39K in slippage costs. The total return on this AMM is around 66 minus 39, so you're making a more modest like 8% annual. So the benefit of our theory is we can also plug this in and sort of calculate the returns on these things. We're going to do an exercise which is more detailed than this and actually look at how profitable LPing for an AMM is. So that's what we want to do. I'm going to skip literature review for reasons of time and jump into our model. Okay, so relatively simple model of price movements. So we're going to work in continuous time and effectively do a Black-Scholes setup. So then we're going to work with two assets, a risky asset, X, which you can think of as Ethereum, and then a numeraire, Y, which is like US dollars, a stablecoin. Assume without loss of generality, risk-free rate is 0. And then an important assumption we make is that we're going to basically assume an infinitely deep centralized exchange like Binance. You can trade an infinite amount and prices don't move. So basically prices move on the AMM. The AMM has bounded capacity. Prices, the AMM is kind of a price taker from the centralized exchange. Now this is obviously stylized. Is it a reasonable stylized assumption? Here on the left, we see market shares of different exchanges. And what you see is that Binance, Coinbase, and FTX added together, 3 of the big exchanges, in terms of volume, is still at this point in time quite a lot bigger than the Ethereum DEXs all added together, right? So the DEXs are a non-trivial market share, but it's still not unreasonable for liquid pairs for like Ethereum USD to assume that most of the liquidity is coming from Binance, Coinbase, FTX, and other exchanges. Not true for all assets, but that motivates basically for some of the liquid assets. Price taking from centralized exchanges is not totally unreasonable. So we're going to assume basically let PT be the market price of the risky asset in continuous time that drifts around with some stochastic, possibly stochastic volatility sigma t. And then so returns are the following. They're like geometric Brownian motion. And then so the instantaneous return is equal to the return volatility times the Brownian increment. And then so we're going to work directly in risk neutral measure. So then expected returns are thus 0. Okay. Now, what is an AMM? This audience is probably somewhat familiar with AMM, so I'll go into this relatively quickly. An AMM is described by a bonding function f, and the bonding function defines a convex level curve, right? And the AMM is relatively simple. Say for a constant product AMM, we have f of xy is equal to xy, and the AMM is willing to basically make any trade such that it stays on this level set, right? So then LPs contribute some amount of ETH, some amount of US dollars, such that the product of these is equal to L. The AMM is willing to make any trade that stays on this level set. And then so, for example, I'm willing to trade from x0, y0 to this point x1, y1. And then the price of that trade is the slope of this line, right? So then if I wanted to trade a bit more x, the price would change, so on and so forth. In equilibrium, the price of the AMM, if Binance has a price P, is going to be, the AMM is going to get to the point where the price is tangent to the AMM level curve, right? And the reason for this is basically the price of doing a small trade with the AMM is just the slope of this line, right? So at any point other than this point where you have a tangency point, there's an arbitrage, there is some profit to be made by basically trading the AMM against Binance. And thus we're going to get to the point in equilibrium where the tangency to this curve, the tangent line to this curve is equal to the Binance price, right? And then so sort of dfdy, dfdx gives you the price of the AMM. So that is an AMM. Fees are collected proportional to traded quantity. For example, on Uniswap v2, any trade with an AMM is going to pay 30 basis points of the trade in fees. And then we're not going to talk that much about this in this talk, but as LPs arrive and depart, they're minting and burning. You can move to higher and lower level sets as LPs, as liquidity providers add or remove money from the pool. Okay, so in our model, we're going to assume there's two kinds of traders. We're going to assume there's arbitragers. And arbitragers basically make sure the CFMM's prices are in line with Binance. They can trade frictionlessly on the infinite depth Binance. And then what they do is they arb the CFMM until the prices are equal to the centralized exchange prices, right? So the people that make sure that this holds at any given point are arbitragers. When Binance prices move, the arbitragers have profits they can make, and then arb the AMM until we get to the point where the prices are equal to Binance. We're going to assume for simplicity, arbs do not pay trading fees, so that's going to simplify our analysis. The other class of traders is noise traders. Noise traders in our model basically are the source of fees. So then basically they're trading for idiosyncratic reasons unrelated to price movements, and then they pay trading fees. The cumulative fees that we collect from market makers are called VT. So you get VT up to point T. Okay, let's jump into the analysis of our paper. Let me define one thing, which is the pool value function at price P. So the pool value function at price P is the monetary value of how much the CFMM holds when the price is P. And then how do we figure that out? If I give you the price P, you can tell me where on the AMM curve we're going to be, right? So if the price is like decreases a bit, we're going to be here. Price changes a bit, we're going to be here, right? At any point, we can just value the inventory position here according to P. How do we value it? We simply say sort of like, what is the US dollar value of the position? It's P times X plus Y, right? And then so V of P is the monetary value of what the AMM is holding when the price is P. I set this up as the expenditure minimization problem. We're trying to minimize the value of the pool subject to the fact that we stay on this level set. Why is this the right problem to solve? You can think basically of the arbitragers as helping the pool solve the expenditure minimization problem, right? Like at any given price, say the price is here, what the arbitragers are going to do is trade until the price gets to this point, right? So then if you remember from consumer theory, the value of the pool happens to be the solution to kind of the expenditure minimization problem, which is minimize the value of the pool while staying on this level set, because the AMM only allows you to trade on this level set, right? The value function helps us analyze returns to liquidity provision, basically because we can write the profit and loss of the AMM as the following. I started with my pool being worth V0, right? As prices move, the value of the pool changes to some VT, and then I have been paid, which I assume is paid in dollars, fees T up to point T in at point T, right? So then we can think of the profit and loss as how much did my pool value change, and then how much fees did I collect. Okay, now let me define kind of the core conceptual idea of the paper. How do we split this pool value change into two intuitive components, right? The core idea is we're going to define a rebalancing strategy. A CFMM, as prices move, is shifting how much it holds in US dollars versus Ethereum, right? Let's delta hedge the CFMM. So let's think of delta hedging by basically running a strategy which does exactly the same trades as the constant function market maker. It holds the same amount of Ethereum as the constant function market maker at any point in time, but does so by trading on Binance, right? And then so informally, we're going to make exactly the same trades at external market prices, right? If you short that thing, then you delta hedge the CFMM. If you long that thing, you're just replicating the CFMM, but doing so at sort of external market prices instead of AMM prices. So formally, in continuous time rebalancing strategy is a self-financing trading strategy defined by the following conditions. We're going to hold the same amount as the pool to start with, and then the risky holdings, X, how much Ethereum you hold, is always equal to the optimal amount of Ethereum held by the pool at any given price, right? And then we're going to let RT represent the rebalancing portfolio's value. And then sort of the returns of the rebalancing portfolio can be derived just from the envelope theorem, right? The rebalancing portfolio starts at V0, and then in any small increment of time, if I hold this much Ethereum, X star, and then the price is changed by a bit, I get X star DP of S, right? X star DP. Now we're just going to write loss versus rebalancing as the difference between what the pool gets and then what the rebalancing strategy gets, right? So loss versus rebalancing is what is your value when you trade at the pool prices compared to if you did exactly the same trades, but if you did so at the Binance prices. And the core result of our paper is to characterize loss versus rebalancing. And as I mentioned, basically loss versus rebalancing up to point T is equal to the integral of instantaneous loss versus rebalances. Instantaneous loss versus rebalancing depends on how much prices move around, how much marginal liquidity the pool is providing. Now let me talk about what is going on here. Here's the intuition so I basically told you the AMM loses because of slippage. Compared to the rebalancing strategy, the reason it's losing is because it always trades at worse prices than the rebalancing strategy. In this picture, suppose we start at price P, the red line. Then we start at point A, right? Suppose prices decrease a bit to P minus DP. Arbitragers are going to trade with the AMM until it sells DX of Ethereum and moves to point B, right? So we move from the red tendency point to the brown tendency point, right? What does the rebalancing strategy do? The rebalancing strategy says, I want to buy or sell the exact same amount of Ethereum that the AMM did. So I also want to buy DX, but I can do so because Binance lets me trade at this price, right? And what the rebalancing strategy does is it goes from A to B star, right? The fact is that Binance offers me this price. The AMM is always trading at worse prices than Binance because the only reason that it knows that the Binance prices have changed is arbitragers trade with it until we get to this point. So loss versus rebalancing, how much you get from trading at the AMM prices versus how much money you would have gotten if you did exactly the same Ethereum trade, but you were able to do that at the Binance prices, is the gap between B star and B, right? So this vertical line. That's how much you're losing, and that's also exactly how much arbitragers are making from you, right? Because what is the arbitrager doing? The arbitrager is buying from you at this price, dumping it on Binance at this price, right? And the arbitrager is making this much. So then AMMs lose money from slippage, and they lose money from slippage when prices move, and then they're making trades at this off-market price instead of this price. So given this intuition, how much and what affects how much AMMs are losing? What affects this is basically that when prices move around a lot, these kinds of slippages are happening more, and you would expect that you lose more money, right? So you expect there to be a DP term here. The other question is when prices move a given amount DP, the size of this vertical line, right, is equal to D. So it depends on DX. So how much are you trading at the off-market prices? If I have an AMM which is very curved, right, what happens is that sort of you're not making very many trades at the bad prices. And as a result, you're suffering relatively little arbitrage profits. If you have an AMM which is very flat, then these DXs are very large. When prices change a bit, you have to get sniped a very large amount before you realize prices have moved. And then basically these vertical bars are bigger. So that's kind of an intuitive picture that shows you basically intuitively, where's the loss of AMMs coming from? The loss is coming from the fact that you're always trading at these bad prices. The more you trade and the more prices move around, the more losses you're making. So that's an intuitive derivation of our formula. At any given point, how much you're losing depends on price volatility, and it depends on how aggressively you are trading, which we write as X prime P. How much are you changing your Ethereum position as prices move a bit? I want to clarify one concept before moving forwards. Our model is kind of a slippage model. In our model, what is going on is the LP loses money because of the fact that the LP doesn't know current prices. And then the LP only learns current prices when it gets sniped, and then loses because by getting sniped, it's trading at prices worse than current prices. So this is kind of reminiscent of Bootish, Crampton, Shim, the HFT literature, where basically sort of I'm running quotes, another exchange has prices change, and then basically sometimes I get sniped and I trade at bad prices based on current information. AMMs are even in a sense worse because of the fact that in the Bootish, Crampton, Shim work, the HFT work, you have a race between the guy making the quotes and other guys, and sometimes the guy can cancel his quotes in time, right? AMMs by design cannot update their quotes in response to price movement. So they always lose when prices move. By design, this slippage is built into the AMM structure. They only learn prices move when they get sniped. Why is it useful? If you're a microstructure person, why is it useful to think of things as being driven by volatility? Because volatility is quantifiable. Informed trading is very hard to quantify. It's doable, but quite hard. Volatility is something we can measure quite simply by just taking variance of returns in the data, right? So slippage depends on volatility and curvature in a quantifiable way. Now you might then ask, are we missing a term because we're not talking about informed trading? Don't AMMs lose money both from this mechanical slippage and also because people have information about where prices are going to go in the future? So I'm not going to go into this too much. I'm happy to talk about this in questions, but it turns out that informed trading is not relevant in this setting because this particular strategy we're running, which is think of the strategy where you long an LP position and sort of short the rebalancing strategy, the delta hedge actually eliminates directional risk. So the standard Gloston-Milgram effect actually doesn't show up in this setting. Only rebalancing slippage matters in this setting. So I'm happy to talk more about this in the questions if anyone's interested. I'm going to very briefly go through the more formal proof of basically this theorem. So I present an intuitive proof based on the picture. A formal proof goes the following way. The value function is the value of the pool at any given point in time. So if you remember from consumer theory, you have a result that the derivative of the expenditure function is the consumer's demand function. And thus the second derivative of the expenditure function is the slope of the consumer's demand function, right? Once we have that, basically what we do is, let's say at any given point in time, what's the incremental change in value of the pool as prices evolve, right? And if you do that, you get a linear term, which is basically depending on the holdings, and you get a quadratic term, which comes from the fact that there's a demand slope, right? The expenditure function is a concave function. How concave it is depends on the consumer's demand slope, right? And then so basically what happens is, I won't go through this in detail, when you delta hedge, you kill the linear term. And then what you're left with is a convexity term, which is the fact that the expenditure function is concave, means that you're losing money over time. V is decreasing over time. How much it decreases depends on the concavity of the expenditure function, which is linked to the demand slope, and how much prices are moving around. So details of this proof are in the paper if you're interested. The profit and loss of the LP pool depends on two things, right? The change in the pool value, which we talked about, and then how much fees we collected over time. And then so we decompose the pool value change into basically the delta hedge component and then this slippage loss component. If we add back in the fees component, we get a three-way decomposition of how much you're making as an LP, right? The LP profit and loss can be decomposed into three components. The rebalancing strategy's profit and loss. This can be thought of as we're holding Ethereum and we make or lose money based on whether Ethereum prices go up or down. The fees, and then these slippage losses. So if we look separately at these components, right, the market risk component, this can be thought of as basically, you can hedge this component out perfectly. If you just short the rebalancing strategy, you're completely eliminating exposure to this source of risk. In the end, once you run the strategy, which shorts the rebalancing strategy, delta hedges the pool, you're basically collecting fees in exchange for suffering slippage losses, right? And then so basically whether this is a good deal or not depends on whether you collect enough fees to compensate for the loss versus rebalancing, the losses from slippage to arbitrages. And so that's how sort of the result of our paper allows us to decompose how valuable is it to LP for an AMM into these three components, the delta hedging component, the rebalancing strategy, and then after you delta hedge that pool, you're left with fees versus slippage losses. You can actually trade this. And then in our empirical analysis, which I'll spend a tiny bit of time on, I'll basically show you what happens when you actually do this in the data, invest in a liquidity pool, and then delta hedge the result. Okay, the other thing I'll note is that our formula is simple enough that you can actually take it to data and measure how much loss versus rebalancing is for any given AMM. So in the paper, we give results for a number of different sort of invariant formulas. We get extremely simple results, as I mentioned at the start, for the constant product market maker, where basically when you have an XY equals K market maker, you're losing basically the loss as a percent of pool value over any period of time is just sigma squared over 8. And so it turns out basically that you can actually use this to quantify how much you're losing in any given AMM pool. So then if you run this with a very simple calculation, you're getting something like 3 bps daily. So what we're going to do next is briefly talk about how we bring this more precisely to data and measure, is it a good deal to LP? So we want to do two things here. When we bring this to the data, we want to first ask a question, does our formula work? can we actually bring this to the data, measure returns on LPs, and like, does our formula for what returns should be actually match the data? Why can we do this? Because we can run two separate things. The first thing we can do is just measure, if I invested in an LP position, how much am I making? If I invested in the rebalancing strategy, how much am I making? And then take the difference, right? So when I do this experiment, I don't use my theory. I don't use my formula, which says LVR is equal to volatility times demand slope. Then I can use my theory, estimate volatility, estimate the demand slope, and then predict if I take fees minus my predicted lever, do I actually match what returns are in the data? So on the one hand, this empirical formula is a theory test. On the other hand, I can use this to measure, is it actually a good deal to provide liquidity in these automated market maker pools? So I have around 2 minutes, I think. So let me briefly tell you the result of this analysis and skip over the details a bit. This is not quite in the posted paper, but it'll be in the paper soon. Visually, this is the total return from investing in a liquidity provision, in an ETH USDC pool. So the first thing you should note is this is very volatile. Why is it so volatile? Largely because you're holding a bunch of ETH and Ethereum is extremely volatile, right? So you might ask a question, what happens if we delta hedge this? How much of the volatility in this curve is just because of the fact that I'm holding a very volatile asset, right? And then what it turns out is that after you delta hedge, you get an extremely smooth line. So the vast majority of the volatility in this strategy is coming from the fact that ETH is volatile. And I won't have too much time to talk about this, but it turns out that our predicted value for what the returns of the delta hedge strategy should be, the green line, are quite close to what the actual returns are in the data, the red line. And then we can do some calculations that show basically how attractive it is to LP in a delta hedge way. It turns out this, as you can see, is a fairly attractive trading strategy. It pays modest returns, but it pays very smooth returns. So the Sharpe ratio on this is fairly high. Okay, so I think I'm like basically out of time. I will take maybe 30 seconds to just mention one thing and then conclude, which is that lever is a slippage cost. You can think of designing AMMs to eliminate slippage. If the AMM was able to see what the price on Binance was and set prices which are related closer to that price, you can actually eliminate some of slippage. So besides the positive implications where you can use our theory to measure how bad LPing is, the normative implications are you can use our theory once we've highlighted where these losses come from to actually redesign AMMs to limit these losses. There are a couple of ideas for how to do this. I won't have time to talk about them. So I just want to conclude in 10 seconds. We have this like Black-Scholes formula for AMMs, we think. So a qualitative way to understand what drives LP returns, quantitative formulas to actually measure what LP returns are given measurable quantities, volatility and marginal liquidity. We tested this in the data, seems fairly well. So yeah, that's our contribution. I'll stop there. Thanks a lot.
Anthony, thank you very much. We're going to use the Q&A to submit questions. I would encourage anyone with questions to type them in. And while you're thinking this over, I just wanted to ask something that occurred to me during your talk. So imagine that in addition to rational arbitrageurs, you also have noise traders in the system who are submitting random orders that are hitting basically this level curve. They're going to have very different economic properties, right? Because rather than bringing you towards the actual price, they're pushing you away from the price. So have you thought about what that would imply economically for the liquidity providers in the system?
Thanks, yeah. So I think I should have been a bit clear. We have noise traders in our model. What the noise traders do is that they push the AMM price upwards, pay you a fee. The arbitrager pushes the price back downwards. So you end up where you started, but you collect a fee. So we just have a fee process, and you can think of the fee process as driven by noise traders. Yeah. And I think that's sort of in a frictionless world where you didn't collect fees, all that the noise traders would do would just contribute fees because they push the price away and somebody is always going to push it right back. Yeah.
Hey, Anthony, I was just wondering, have you thought to look at, because there are multiple, ETH USDC pairs, like for example, on Uniswap, have you thought to look at, mostly differing in fee levels, and then that has implications for liquidity and things like that. So I was wondering if you looked at differences in returns based on those fee pairs to kind of see if there's some interesting trade-offs.
Yeah, so I'm looking forward to, you guys favor on on theoretically how that works, and also we're kind of looking at that, but don't have much results on that yet. Yeah. Yeah, the theory is, I think, open. We're not taking a stance on how much, like, equilibrium in liquidity provider world, right? So we're not taking a stance on sort of how high returns have to be for liquidity providers to go in. Our framework more is designed for like measuring, like, given volatility, given fees, how much returns you're making. So we can't theoretically say much about that. It would be quite interesting empirically to see which pools tend to pay more profits. Yeah. I guess I'll hit some. Should I start going through the Q&A questions? All right, so I guess there's a question Q&A. If we move away from infinite liquidity on the external market, how will this change the result? My intuition is that if there's price impact on the external market, then some of the volatility is going to be sort of, the arbitrageurs are going to make slightly less profits because arbitrage is going to kind of move prices a bit in the external market also. I think that, and they're going to arb the prices somewhat less. There's going to be slightly less loss from the LP because sort of you end up somewhere in the middle rather than going all the way to the Binance price. That's my intuition. We haven't worked that out yet. I don't know if my co-authors want to jump into with any response to that. Yeah. Yeah, and for the other question, numerical tests on less liquid pools. No, we haven't done that yet. That's quite interesting to see. So yeah, we have not done that yet. Yeah. So then there's a question: did the empirical analysis at the end include trading fees in the calculation of hedge rebalancing? So I don't think so. Ciamac, is that correct? So I don't think we include the Binance fees when we are doing the rebalancing trades. Yeah.
So that's right.
Oh, yeah.
We include the trading fees in the pool; those are included in the results. But we assume that trading on Binance is just done at mid-market, and we're also not assuming there's probably financing costs to sort of being short a large amount for a long period of time. So we're not including those.
And then I think there's a question from Shihao, which I also was not totally understanding. I don't know if Shihao, if you want to try and clarify your question. So, yeah. I think that the way we look at the cost of LPing is exactly this slippage cost, right? When prices move on Binance, and suppose you want to adjust how much Ethereum you hold, right? We assume Binance is infinitely deep. It's a lot deeper than the AMM. So the AMM could do that trade and adjust its position. It could do so at the Binance price. It instead does so at this kind of price, which is halfway between the current price and the Binance price, right? And then so sort of we think of the costs of AMM as the fact that you're going here when you could be going here, right? And we think this is a nice definition of cost because firstly, I mean, this is the monetary US dollars you are losing from doing this trade at a bad price rather than a good price. It's slippage. And the second thing is the arbitrager is making this profit. And then so that's a sense in which we want to frame the main costs that an AMM faces as this slippage. It seems nicely internally consistent. That's how much dollars you're losing. That's how much the arbitrager is gaining from trading with you. So I hope that clarifies a bit what we're trying to do here. Yeah.
All right, if there are no further questions, we're going to move to our second presentation. Actually, a couple of points that were raised here, they connect nicely to our second paper. One, the question about what happens to the refractions on the centralized exchange. That obviously is the topic of the second paper. That's going to have economic implications for the automated market makers as well, because it affects the flow of orders. These two systems are competing with each other. I was also wondering what the implications are of these results for the design of these systems. Of course, that doesn't allow you to talk about optimal design because this is just one piece of the puzzle. And something that Anthony left out was basically how the level of this bonding function changes as capital moves in and out of the system. So that's kind of left. That also has a lot to do with the topic of the second paper, how capital is going to get attracted to this. So with that, let me introduce our second speaker. Fahad Saleh, he is actually one of the co-organizers, so thank you for bringing us all here. And he is an associate professor of finance at the Wake Forest University. His research centers heavily on various topics in cryptocurrencies, more broadly, fintech, and smart contracts, and so forth. And the paper that he's going to talk about is about the need for fees at a DEX, how increases in fees can increase DEX trading volume. So Fahad, the floor is yours. You have 30 minutes.
Okay, thank you. Can you hear me? All right, great. So let me full screen this. So this paper is joint with Joel Hasbrouck at NYU Stern and Thomas Rivera at McGill. Thomas is also actually here on the virtual panel, so he'll be helping me with the Q&A, thankfully. So with that said, let me dive right in. Now, this paper, what it does is it provides a model with the aim of understanding the economic implications of different fee levels at a decentralized exchange, or more properly at a liquidity pool at a decentralized exchange. So typically liquidity pools at decentralized exchanges charge a proportional fee on the trading that you're doing. And we're looking here to try to understand what are the implications of, for example, if you have a pool that charges 1 basis point versus 5 basis points versus 10 basis points. Those are all sort of typical fee levels. What are the different economic outcomes that arise as this fee level, this exogenous parameter is tweaked with? And now, of course, a model like this generates a whole bunch of predictions, as any economic model with a certain amount of as any economic model with a certain amount of pieces would do. But rather than just sort of trying to detail all the predictions of the model, I want to actually focus in on a particular point that arises out of this model, which I think is particularly useful because it highlights an important distinction between decentralized exchanges and centralized exchanges. And so that important thing that I want to basically spend the entirety of this presentation on explaining is that increases to the fee level at a decentralized exchange can actually be beneficial for users. So this, if it sounds counterintuitive, it should, at least in the context of centralized exchanges, because normally you would think that if I raise the cost of the fee that you're paying, that's not going to be so good for people who are trading at the exchange because they have to pay more and they don't like that. But that intuition turns out not to actually be true in the setting of a decentralized exchange in general. And that then I think becomes an important distinction to internalize when we talk about DEXs as opposed to centralized exchanges. So first, I want to provide a little bit more depth on what I mean here by an increase in the DEX fee can actually benefit users of the exchange. So more explicitly, what I'm saying is when you think about a liquidity pool with a low fee level, which most pools I would say actually have fairly low fee levels, like a basis point or 10 basis points, incrementally increasing that fee can actually reduce overall trading costs. And again, this is a little bit maybe counterintuitive in the context of a centralized exchange, because you are increasing the cost of paying the fee. And so you might think then that overall trading costs would go up when you raise the fee. But it turns out in the setting of a DEX, actually, when you increase fees, when they're initially at a low level, that trading costs are actually going to go down. So I think first, let me clarify, before I get into the formal model, I want to clarify the basic economic channel at a high level as to why an increase in the fee level could actually reduce trading costs. And hopefully that'll clarify then why DEXs are such a different object than centralized exchanges. So for starters, the first thing to understand is that total trading costs are not just the fee cost that you pay. There is a fee that you're going to pay, but you have to also incorporate the fact that that when you trade, the price that you get is not necessarily going to be the fair value of the asset. So in particular, typically in practice, when you're trading, you're going to start to push the price against you. And so if you push the price against you a lot, that is, if you have a lot of price impact, that's really expensive. And so what's actually happening at a DEX is that the trading fee is related endogenously to the price impact that you're inducing. And so the reason that you can have a reduction in trading costs at a decentralized exchange when you raise the fee is not because you're not paying more in fees. It's because somehow you're paying less in terms of the price impact that you're inducing. And indeed, it can be the case not only that price impacts reduce as the fee level goes up, but that they reduce by so much that the overall cost of trading is actually going down. And again, this actually particularly happens when the fee levels are low. So raising the fee levels from very low values can actually be very beneficial to the users of the exchange. But with that said, then, so why would increases in the fee level reduce the price impact? Why would they ameliorate the price impact that you would typically expect to get? Well, that basically boils down to two key institutional features that apply to decentralized exchanges, and again, differentiate them importantly from centralized exchanges. So the two important institutional features here are that, first of all, DEXs have to source their inventory in a decentralized fashion because they're not centralized. And how they actually source their inventory is by providing incentives for essentially anybody to provide inventory to the DEX. And the incentives that they provide are basically the trading fees. So when the fees are higher, or at least when the trading revenues, when the overall fee revenue from trading at the exchange is higher, this provides a stronger incentive to provide inventory to the decentralized exchange. But that then comes together with this second institutional point, which is pricing at the DEX, as was alluded to in the prior talk, is based on a mechanical pricing function. And these mechanical pricing functions actually typically embed a relationship whereby price impacts relate negatively to inventory. Now, in some sense, that's a mechanical feature because the function is mechanical, but it is actually sort of a sensible way of specifying these things, by which I mean that you don't want to allow people to completely deplete the inventory of your DEX. And so one way to sort of to keep people from depleting your inventory is you charge them more and more as they try to buy more and more of your inventory. So the typical pricing function at these DEXs, it has increasing and convex price impacts that in fact diverge as you get to the total inventory size. So then if you put these 2 points together, you get that, well, if the fee increase is going to actually increase the overall fee revenue that's generated by the pool, that incentives to provide inventory are stronger, you'll get more inventory. And when you get more inventory, because of the way the mechanical pricing function allows price impacts to decline with higher inventory, the price impacts are going to fall. And again, so if the price impacts are falling by enough, then the overall trading costs are going to decline. And in fact, that's what we show, which is that when the fees are small, raising the fees will actually allow the price impacts to decline by so much that the overall cost of trading is also going to decline. So just to kind of give the 30,000-foot view here before I go into the actual model, again, the finding that I want to really emphasize here, which is important particularly because it differentiates DEXs from centralized exchanges, is that when DEX fee levels are low, increasing the fee incrementally actually can reduce trading costs, and so it's beneficial to users. And the high-level economic channel for this is that when the fee levels are low to begin with, increasing the fee level by a little bit is actually going to increase the overall trading fee revenue that you generate. And when you increase the overall trading fee revenue that you generate, that's providing more of an incentive for investors to provide inventory to the DEX, so you get more inventory. And when you get more inventory, the price impacts reduce because of the way that the AMM function is typically specified. So that's sort of the 30,000-foot view. But then let's look into the actual sort of formal model that we have. So we're interested in understanding how investors and traders interact with each other. So we're going to model both investors and traders and their strategic actions. It's sufficient to think about normalizing the investment horizon to a single period. So we're going to look at a single period in time. And so how is the action going to unfold? Well, basically, investors at the outset have to decide what they want to do with the capital that they have. Within our framework, they can invest their capital in the DEX, which basically means providing inventory to the DEX. which they understand will later provide them with a share of the fee revenue. They can do that, or they can put their capital into whatever their alternative investment opportunities are. So we're going to allow for a heterogeneous alternative investment opportunity for each investor, and they're just going to be basically deciding to invest wherever they get the highest expected return. And that is going to happen at the start of the period, where they're going to anticipate all the future action. So now, what is the future action? Well, during the period, traders are going to arrive, and they're basically going to be liquidity traders. They're going to have a heterogeneous demand to trade, but they have two venues in which they can trade. They can trade either at a DEX, or they can trade at a centralized exchange. And they're going, and they are liquidity traders in the sense that they need to trade, but they're going to rationally choose to trade wherever it's cheapest to trade. So you're going to have endogenous demand essentially here at the DEX, precisely because there's a competing exchange, which is the centralized exchange. And so at the end of the period, there's going to be some trading fee revenue that's accumulated based on these decisions that traders are making during the period. And DEX investors, meaning those investors who actually chose to supply inventory to the decentralized exchange, they're going to receive a pro rata share of the trading fee revenue. And of course, they're going to internalize this ex ante, and that's how they're going to make their decision. Now, getting maybe a little bit more into the details of it, the traders are going to arrive during the period according to a Poisson process with unit intensity. The specific dynamics of how they arrive isn't particularly important. This is just sort of a traditional way, of course, in which people model the arrival of traders. As I was saying earlier, we allow that traders have heterogeneous trading demand. So trader J has a demand delta J, which is drawn from, in this case, a uniform distribution, which is supported negatively and positively. So negative means that you are selling ETH, and positive means that you are buying ETH. And what are the traders going to be solving for? Well, they're basically choosing the exchange that gives them the trade at the lowest cost. So as I said earlier, they can trade at a centralized exchange, or they can trade at a decentralized exchange. And so here we have this function psi to represent the trading cost at the particular exchange. And the trading cost, of course, also depends on the particular size of the trader. So they're just going to choose the venue that happens to allow them to trade most cheaply. But so then what is this psi function? That is, what exactly is the trading cost at the decentralized exchange versus centralized exchange? Well, in either case, as I was saying sort of in the introduction, trading costs are going to decompose into two pieces. There's the cost from the fees that you pay, and then there's the execution price. So the cost from the fees that you pay is fairly straightforward. Whatever the volume that you're trading, there's some exogenous proportional fee that is stipulated either at the centralized exchange or the decentralized exchange. So for example, just to use round numbers, although they might be slightly outrageous, if you want to buy 100 ETH and the fee is 1%, that means you got to pay 1% of 100 ETH, which is 1 ETH. But of course, you don't care about things in terms of ETH, you care about it in terms of numeraire or consumption goods, or in this case, we're going to say USD. So you have to take that 1 ETH and multiply it by whatever the value of ETH is to get the actual cost of the fee to you in terms of what you care about. But that's sort of the less important part of these trading costs. The more important part is coming from the execution price cost. And so the execution price cost is, of course, going to scale with the size of your trade. But the really important part is that the price functional for the average price per unit is going to be different depending on whether you're trading at a centralized exchange or a decentralized exchange. So what is the difference between this pricing function between a centralized and a decentralized exchange? Well, at a centralized exchange, we're gonna sort of adopt a mindset similar to Gloston-Milgram's 1985 paper, but we're abstracting from asymmetric information. And so the consequence is that the pricing at the centralized exchange is going to be fairly straightforward, which is to say that at the centralized exchange, because of the lack of asymmetric information, you're going to be trading at the fair value of the asset. As a parenthetical note, some of the most widely traded, widely traded pools for Uniswap are actually stablecoins against stablecoins. And so in that context, there really is unlikely to be any sort of meaningful asymmetric information. So if you don't like thinking about this in terms of ETH USDC, because this assumption, you could think about it in terms of the DAI USDC pools and other stablecoin for stablecoin pairs. Although you can generalize this even to incorporate asymmetric information, but this is sort of easier to think about. So the centralized exchange, therefore, is fairly straightforward, and the focus is more on the decentralized exchange. For the decentralized exchange, as I was saying, and as Anthony was mentioning in the prior presentation, they use a mechanical pricing function, and typically they use what's called a constant product automated market making function, where you really do have a mechanical formula for the price, and so that's what you see sort of given on the middle of the screen. But importantly enough, it's not sort of a static function because it reads off what the inventory is available at the decentralized exchange. So in particular, you can see the CPAMM function has as arguments not only the trade size delta, but also the inventory of, say, the stablecoin USDC and the asset that you're trading, ETH. And so depending on the level of the inventory, the price impacts of this function are going to be different. So what then really becomes important is understanding what these inventory levels are likely to be, because these inventory levels are endogenous objects. And so they need to be determined in equilibrium. So while the function is mechanical, that doesn't mean that there isn't some sort of economic depth to explore here, because the inputs to the function are endogenous objects. And so they need to be determined in an equilibrium framework, which is precisely what we do. So the inventory on that previous slide, again, is provided by investors endogenously. So then let's talk about the investor problem. Investors, as I was saying earlier, we're going to allow that they have alternative investment opportunities, and we can subsume this into an outside option. So investor K has an outside option rho K, which is generated from some distribution G, and the investor is going to be rational and risk neutral and is going to choose whatever investment opportunity provides the highest expected return. So in particular, we're using this notation RDEX to denote the return from investing at the decentralized exchange. If that is higher than the investor's opportunity cost, then they're going to invest at the decentralized exchange. They're going to provide inventory to the decentralized exchange. If, on the other hand, that the return on the investment, the return on investing at the DEX is lower, then they won't. Now, an important point here is that this return on this net expected return from providing inventory to the DEX is conceptually quite straightforward, but there's some complexity in terms of properly understanding it in equilibrium. So first, just in terms of what it means at a conceptual level, the return you're going to get is the trading fees that are generated divided by the capital that is put in. So the fees are actually random, so it's the expected trading fees. If you're risk neutral, that's what you're going to care about, divided by the total DEX investment that is actually provided. But the important piece here is that everything in that equation is endogenous. So you can't just sort of state it. If you want to think about an equilibrium framework, you have to dig a little bit more deeply into it. And in fact, this thing is crucial to thinking about the existence of equilibrium. So all the primitives have sort of been stated up to this point, but we need to dig into basically this particular equation to understand whether an equilibrium even coherently arises out of this, right? And so first, just to clarify at a conceptual level, the complexity involved here, not only are all these objects endogenous, but they're very much interrelated. So in particular, on the left-hand side, you have the return from investing in the DEX. On the right-hand side, you have two quantities that are endogenous and that depend upon the return from investing on the DEX. So perhaps the thing in the numerator, in the denominator, total DEX investment, it's much more straightforward to understand that relationship, which is that if the return on investment at the DEX is higher, then DEX investment is going to be higher in equilibrium. So it's clear that there's going to be some increasing relationship there that we have to take into account. The relationship for trading fees in terms of the return of investment on the DEX is a little bit more subtle. It's actually non-monotone. So let me sort of briefly walk you through that just so that you have an understanding of how we actually solve for equilibrium here. So trading fees, of course, depend on trading volume, right? All things equal, if there's more volume, then the trading fees are going to be higher. But the trading volume is going to depend on the trading costs. That is to say, if it's cheaper to trade, for example, at the DEX, all things equal, you're going to get more trading volume. If it's more expensive, you're going to get less trading volume. But trading costs, as we said, have two components, one of which is the execution price. And so price impacts are going to matter to determine the trading costs. And price impacts, due to the AMM pricing, depend on inventory levels. But inventory levels, well, inventory is provided by investors. So inventory levels depend on investment. And investment, as we said, depends on the equilibrium return of the DEX. So both those things depend on the return on the DEX. And so if you want to actually demonstrate that there is an equilibrium here, you essentially have to compute out what the expected trading fees are as a function of the return on investment of the DEX, and the DEX investment as a function of the return on the DEX. And you basically end up with this one equation, this nice sort of fixed point problem, which is now given on the middle of the slide. And importantly enough, everything in that equation is exogenous except for the return on investment at the DEX. So if there exists a solution to this, there exists an equilibrium. If there exists a unique solution to this, then the equilibrium is unique. Importantly enough here, G is a cumulative distribution function. So it turns out if you think about it for long enough, you realize that not only do you get existence, but you get uniqueness under fairly reasonable conditions on the cumulative distribution function G. And so we we demonstrate existence of a unique solution. I should say a unique non-trivial solution. We're not interested in the case that nobody invests in the DEX and price impacts are infinite, and that ends up being a sustaining trivial equilibrium. We're interested in cases where there is actually some activity at the DEX, and that we show is unique under reasonable conditions on G. But then once you have the return of investment on the DEX, essentially everything else unfolds from there, all the interesting things like trading volume and trading costs. And so that's how we solve for the equilibrium. But then with all of that sort of set in place, let me actually go to the formal results of the model and a bit restate myself, but maybe with a little bit more precision. So the truth is that trading costs are actually quite heterogeneous in that the way trading costs are going to change for somebody who's very small, has a very small trade versus a very big trade, is going to be a little bit different. So a way to sort of think about trading costs in aggregate is actually to think about trading volumes, because trading volumes are, as we said, a function of trading costs, where if trading costs go down generically, trading volumes would pick up because more people will trade at the sort of cheaper venue. And so the first result we put across that sort of conveys this point is that trading volumes, endogenous trading volumes, are first increasing and then decreasing in DEX fees. So if you start at a DEX fee of 0, you basically have no trading volume whatsoever. As you raise it, you start to get an increase in trading volume, but at some point that reverses and it starts to decrease. And again, as a practical matter, I think it's important to note that fees at liquidity pools, many of them are actually quite low. So what this suggests then is that maybe some of these pools would be able to generate even higher volumes if they were actually raising their fees a little bit, right? And sort of more in the formal language here, there exists an interior optimal fee level, which is between 0 and the fee at the centralized exchange, such that as you move up to this level, the derivative of the trading volume is increasing, and then after it is decreasing. So there's an interior optimum. And I think it's actually an interesting thing to think about whether some of these liquidity pools are sort of suboptimally low on. But why are these trading volumes exhibiting these sort of non-monotonic features in terms of DEX fees? Well, this goes back to sort of what I started with, which is it's about trading costs. If trading volumes are going up, it's because trading costs are going down for somebody. And so more formally, there's a marginal trader who is indifferent between trading at the DEX and the centralized exchange. And when the fee levels are low, as you raise that the fee level, you actually reduce the marginal trading cost for the trader at the decentralized exchange, which is how you get the increase in trading volumes. And after some sort of interior optimum, then it starts to go the other way. So again, this is sort of just stated more formally in math, but at a high level, again, there's an interior optimum. And again, I think it's sort of interesting to think about whether we are above or below that interior optimum in practice. So why are trading costs behaving this way? Well, it boils down again to the price impacts. So price impact formally is just the derivative of the price function with respect to the trade size. And so just as trading costs are non-monotone, so are these price impacts. If you start fees at 0 and you increase them from there, the price impacts are first going to decline, and then they're going to increase. So again, raising fees when the fees are very low can be advantageous to users because they might actually experience lower price impacts and lower trading costs. And then this brings us back to sort of those key institutional details associated with the decentralized exchange as to why price impacts decrease and then increase in fees. This is because the inventory is decreasing and increasing in the fee level, and price impacts are monotone decreasing in the inventory, right? So when you increase the fee level, when the fee level is low and you increase the fee level, what you actually are doing is you're increasing the overall trading fee revenue that's produced. This is then increasing the endogenous inventory. The endogenous inventory is then having the effect of reducing the price impacts. If you go too far, this effect reverses. If you go too far with the fee, then actually increasing the fee level is going to reduce overall trading revenue because you're going to push so many people away to the decentralized exchange that even though you have higher fees, the volume will be so much lower that that the overall trading fee revenue will go down, and in that case, the price impacts will actually go up. And again, the price impact relationship you see here it's for any inventory level because it's just coming from the mechanical pricing function, so it even holds out of equilibrium. Okay, so with that, let me actually conclude a little bit ahead and just summarize the main point that I was making, which is unlike in a centralized exchange, the interesting thing here is that increases in DEX fees can actually be beneficial to users. Normally, you might think that charging your users more is a bad thing for them at least, but in this case, it turns out it can be sort of advantageous for everybody. And that's because it's reducing trading costs to this endogenous relationship between the fee level and the price impact. That is, when DEX fee levels are low, increases in fees are actually going to increase the trading fee revenue and reduce the inventory, increase the trading fee revenue and increase the inventory, just increasing the incentives to provide the inventory. The increase in inventory is going to bring down the price impacts, but this effect reverses for higher fee levels, which means that there's an interior optimum. And this is this is a theoretical economic analysis, but it very clearly, I think, makes this point, which then I think leads to a natural empirical exercise that I think somebody should do, which is think about whether existing pools are above or below this interior optimum. But with that, then I will conclude just by highlighting that if you want to read the paper in all of its depth, it is available on SSRN, and there's a very convenient tiny URL, DEX fees, if you would like to get to it quicker. But with that, I will stop a little bit ahead of time here.
Thank you, Fahad. We have a question through the Q&A if you want to take that.
Okay, let's see. So I'm gonna read it out. So just on the high level intuition in centralized exchanges, if fees are proportionally passed to liquidity providers, would it also reduce the information cost for the traders? Presumably with more liquidity, price impact is smaller, even without a mechanical formula. I'd have to think about that a little bit more, in part because, I mean, in a sense, we're thinking of a framework where there isn't really any information. And as a practical matter, you could even think about it through sort of, stablecoin pairs. So it's not clear to me, I guess, how that would work at a first pass. But I guess I have to think about that a bit more. Okay, it looks like we have another question rolling in here. Have you also considered the impact of competition among DEXs? How would this impact the result? So actually, that's a very interesting question. We haven't put it in the formal analysis, but we have actually thought about that point. And so essentially what that does is it imposes an indifference condition across liquidity pools. So I should say, in terms of thinking about the scope of our work here, if you think about something like Uniswap, there are trading pairs where there's only one active liquidity pool. And so you want to think about the stuff that I presented here in the context of those sorts of trading pairs, because sort of precisely to, I think, what this question is alluding to, when you have multiple active liquidity pools of the same trading pair, now when you change the fee at one, you have to maintain the indifference condition across the two of them. And essentially what that means is sort of, you can think about it as the expected returns, or at least the risk-adjusted expected returns across the pools would have to be equalized. And that is something, you know, we've put a fair amount of thought into, and there's some interesting insights there, but they're not quite ready for prime time. So I'll defer that for now.
I was wondering, actually, if you wanted to take advantage of these results and try to improve on how a fee is set, of course, you need to know a bunch of stuff to do that. But is there a way to design some kind of automated scheme that will sort of search for the optimal level of fees over time?
Yeah, so I think actually, if you were thinking about this practically, for us, and you wanted to sort of optimize the fee level, let's say to maximize trading revenue, actually one of the things that that you might come to pretty quickly is that fees on for the liquidity pool should be related to fees for the underlying blockchain, meaning gas fees. Because actually, so in our model we abstract from gas fees, but if you think about it practically, it's the total cost of trading that's going to matter. And so both from the perspective of if you want to do an empirical estimation to the perspective of if you want to actually implement a function in there, when in practice you have heterogeneity on the underlying gas fees. And so what that means, sort of like, think of it this way: if the total optimal fee is something like, I don't know, just taking round numbers, 100 basis points, and gas fees are really high, like they're 90 basis points. Now you want it to be 10, but then if gas fees go down to 10, you want it to be 90. And so you can use gas fees both as a source of heterogeneity to estimate what that optimal overall cost is, and you know that means then that when you implement it, I think it's actually a very common sense thing to say that, look, if the system is really congested, now my interior optimum is going to be pretty low. If the system is not congested at all, it's going to be very high. And the thing is, it's not hard to actually code that, right? Because the gas fees are known to the blockchain. So that would immediately, I think, be sort of like a low-hanging fruit for practitioners if they wanted to do something. Me not being an empiricist, I'm not going to weigh too much into the sensitivity of exactly what that function should look like, but I would imagine you would want a decreasing function of gas fees for how you set your protocol, how you set your liquidity pool fees.
Well, if there are no further questions from the audience, then we're going to give everyone a few minutes back. It looks like we're ahead of schedule, which is unusual for these things. Well, thank you to the presenters for sharing their work. Very interesting set of results. It's a growing area, as I said, and these are steps forward. Thank you for all of you joining today. And I hope you enjoyed the rest of the day and the other events. Thank you.